Well, if you follow this channel, you are probably not surprised by today's news from the tech sector. Snap reported Q3 earnings today and, guess what? The numbers are worse than feared. Shares in Snap sunk by over 25% in after-hours trading following what I would call a disastrous Q3 earnings call. But what should we really expect? And should we expect things to get worse from here? Well, you already know the financial narrative of the times. Inflation is raging in most countries of the world. Central banks are aggressively raising interest rates in order to tame inflation. Consumers are having to spend more on necessities like food, energy, and housing. So, consumer budgets for discretionary items are being squeezed. As a result of that, corporate marketers are cutting back on ad spending, especially online. And, online ads are the lifeblood of most big tech companies. Add to that the fact that TikTok is vying for its growing share of ad dollars. And other big tech companies, like Snap, Google, and Meta, are being squeezed. Snap and Meta have already been reporting revenue declines for 2 quarters. So, they are no longer growth stocks. Wall Street analysts are no longer valuing growth in the absence of profits. So, that means shares in tech companies are getting severely punished. Layoffs are now a fact of life at basically all tech companies. That includes Snap, who, last month, announced that it was cutting 20% of its workforce. Will they have to cut more? Only time will tell. What does it mean for the stock market? What does it mean for big tech companies? What does it mean for employees of technology companies? What does it mean for the future of the economy? And, what does it mean for the future of the United States? But, before we get into all of that, please hit the like button and leave us a comment below. We would love to hear from you. Please subscribe and hit the bell icon so that you are notified of upcoming videos when they are released. Shares in Snap fell by over 25% following the company's Q3 earnings call. The social media giant reported weaker than expected revenue in its Q3 earnings call after the close of the stock market today. The online ad market has been weakening. And Snap's Q3 earnings report is basically the first from the big tech companies. If there is any good news, it was that Q3 revenue was actually 6% higher than Q3 of last year. That this is the first time that revenue growth from one year to the next is in the single digits. Which really means not much growth at all. Snap lost $360 million in Q3, which is a 4 times increase. However, that included $155 million related to a restructuring charge. Another little bit of good news was that daily active users went up 19% from Q3 of last year. So, it shows that Snap is still able to attract users, which is a positive. But, as you might expect with a weakening ad market, average revenue per active user decreased by 11% from last year. If you follow this channel, you already know that Snap announced a 20% layoff. Snap is nowhere near as large as Google or Meta. It has only about 6,000 employees. The company also announced a restructuring. And they took a $150 million charge in Q3 related to the restructuring, which was mostly for severance payments. Our revenue growth continued to decelerate in Q3, Snap said in a note to shareholders. Revenue continues to be impacted by a number of factors we have noted throughout the past, the note continued. Those factors include platform policy changes, macroeconomic headwinds, and increased competition, the note also added. We are finding that our advertising partners across many industries are decreasing their marketing budgets, the note continued. This is especially true in the face of operating environment headwinds, inflation-driven cost pressures, and rising costs of capital, the note also added. Like its larger peers, Snap refused to provide Wall Street with any sort of forward guidance. This is now the second consecutive quarter in which the company declined to give guidance to Wall Street analysts. Forward-looking revenue visibility remains incredibly challenging, Snap said in a statement. This is compounded by the fact that revenue in Q4 is typically disproportionately generated in the back half of the quarter, which further reduces our visibility, the company statement continued. Company management did make it clear that it expects revenue declines to continue quarter to quarter. Q4 has historically been relatively more dependent on brand-oriented advertising revenue, the company's statement also added. Apple's 2021 privacy update to iOS has basically been something of a whipping boy for ad-based tech giants. The Apple privacy update makes it more difficult for Snap, Google, Meta, and other big tech companies to track user activities online. And that severely impacts the value that these ad-based tech companies can provide to their customers. Google and Meta also blamed the Apple privacy policy update in their Q2 earnings calls. Meta has scheduled their Q3 earnings call for next week, and the results should be very telling. If you follow this channel, you already know that recession fears have gripped the nation. Consumers have tightened up their spending, especially for discretionary items. So, corporate marketers have cut back on spending, especially online. Shares in Snap are down 75% since the start of 2022. And they have lost 30% of their value since July, when Snap last reported earnings. If you recall from July, Snap basically missed Wall Street expectations for both revenue and earnings. Shares in Snap look as though they are headed down to 2019 levels. But in another stroke of good news, Snap's board authorized the purchase of $500 million in company stock. Which I would say is a show of confidence in the company. Snap ended Q3 with $4.4 billion in cash and cash equivalents. So, it definitely has the cash to repurchase shares, especially if it takes place over a few years. Snap detailed some of its riskier and expensive developments. For example, it cut the Pixie drone development. It also cut Snap Originals premium shows. In another little bit of good news, Snap said that its Snapchat Plus subscription service now has 1.5 million paying subscribers as of the end of Q3. Snapchat Plus is now available in over 170 countries. Snapchat Plus costs $3.99 per month. If you follow this channel, you already know that 2022 has been something of a financial disaster for Snap. Snap missed on both earnings and revenue for Q2. This came as a surprise to Wall Street analysts. Since its disastrous Q2 earnings report, Snap management has refused to provide forward guidance to Wall Street analysts. Snap management said, "Forward-looking visibility remains incredibly challenging. That means that financial performance is going to get worse and not better, especially within the next year." On the day after the Q2 earnings release, Snap shares fell by more than 25%. A weak advertising market and other macroeconomic factors were cited by Snap management as the reasons for disappointing earnings in Q2. Meta Platforms and Pinterest also wildly missed Wall Street estimates for both revenue and earnings for Q2. Snap, Meta, Pinterest, and other social media giants also blamed the most recent Apple iOS update for their disappointing sales and earnings. The new iOS update makes it harder for social media companies to track users, and this negatively impacts online ad sales. Snap overhired during the COVID-19 pandemic. Are layoffs imminent at Google? Google employees were told by management that there would be an overall review of sales performance and performance in general. Many big tech companies are announcing hiring freezes and layoffs. In phone calls over the past few weeks, tech executives have spoken of layoffs and hiring freezes. But, what do you think? Please press the like button and leave us a comment below. We would love to hear from you. Please subscribe and hit the bell icon so that you are notified of future videos when they are released. Please share this video on social media. Thank you for watching.